But the important thing, I think, irrespective of what form of gold ownership is most efficient for you, most comfortable for you, most convenient for you, is to do something. Gold, this amazes me. We were having a discussion before we went on the air about how incomplete knowledge of gold was in our market in the United States. The ownership of gold, physical precious metals, or put differently, the market share of precious metals and precious metals related assets relative to other savings and investment asset classes in the United States is tiny. Less than 0.5% of total savings and investment assets in the United States is denominated in precious metals. The 4-decade mean is 2%. If precious metals ownership returns to historic means, I think it's going to go through it. But if it returns to historic means, that means the demand for the stuff grows fourfold. I have no idea what that will do to price, frankly. I don't have a price target. But I suspect that if you have a fairly thin market and you increase demand by 4 times, that it has a really outsized impact on price. Let's look at that, too, from a historical viewpoint. The reason I want you to look at it from a historical viewpoint is you don't need to over-own gold. Because when it moves, for the reasons that cause it to move, it moves much further than people believe it's going to move. The sterling example, of course, poor pun, was the decade of the 1970s, when the gold price in 10 years moved from $35 an ounce to $850 an ounce. What's that, a 30-fold move? I don't know what it is. It's big.
Yeah.
A more reasonable comparison is probably the decade 2000 to 2010. Pretty good gold bull market too, although most people didn't pay attention. But the gold price moved from $253 an ounce to $1,700, $1,800 an ounce, which is to say a 7-fold move.
Now,
Andy, when people interview me in circumstances like this, they often say, Rick, do you think that the gold price is going to go through 3,000? I could care less. 2,700 to 3,000? Pardon me? I own gold because I'm afraid that it's going to go through 9 or 10,000. If we have a circumstance where the arithmetic that I've described to you around the deterioration of the purchasing power of the U.S. dollar relative to the yield offered up on U.S. treasuries becomes widespread, the damage to the credit markets and the benefit to the gold market would be extraordinary.
mm-hmm.
Am I telling you that this absolutely, positively, without fail is going to occur? No. I'm telling you that it's a probability that you should insure against. And a little bit goes a long way. Let's say that coming into the decade of the 1970s, that you were a retired person and you'd enjoyed the period 1946 to 1970 a lot. If you had put 10% of your wealth in gold and you had 50% of your wealth in U.S. treasuries and 40% of your wealth in stocks, the stocks over the course of the decade would have lost you 30%. The long treasuries would have lost you 50%. So you'd be down an average of 40% of your wealth. But your gold would have increased in price 30-fold, which means that it would have more than offset, although it was only 10% of your portfolio, the losses that you had endured on 90% of your portfolio. A better example might be the decade 2000 to 2010, where financial assets did well, frankly. The truth is, had there been a problem with the treasury market, or had there been a problem with the stock market, an investment of 10% of your portfolio in gold would have seen a 7-fold improvement in that asset over the course of 10 years, which is to say it would have shielded your portfolio from a lot of sin other places. Now let's look at the probability of that sin. I'm going to leave the equity market out of it because I don't consider the equity market to be a savings product. I see it as an investment product. The U.S. Treasury is an obligation of the U.S. government. First of all, the economic proposition is lousy. They absolutely, positively will pay you back interest and principal. They'll do that because they have recourse to the printing press. But they'll pay you back 4.2% in a currency where I believe the purchasing power is declining by 7.5%. In other words, they guarantee you a 3% annual loss. So the arithmetic around the U.S. 10-year Treasury is, from my point of view, not good. Caveat, I own some 18-month Treasuries for liquidity, just not the long ones. But let's look at something else, which is to me a lot more treacherous. That is that the on-balance sheet liabilities of our country, that is to say the debt owed the bondholders, now exceeds $36 trillion, or $29 trillion net of the Treasury's own holdings of bonds. In other words, some of our debt we own ourselves. So let's call it $29 trillion net, a paltry sum. But we add back to that a truly frightening sum. The net present value of the off-balance sheet liabilities of the U.S. government, promises that we've made, Social Security, Medicare, Medicaid, federal pensions, military pensions, that number, according to the Congressional Budget Office, exceeds $100 trillion. By the way, that's one of the lower estimates out there. The debt clock, debtclock.org, suggests that the net present value of unfunded liabilities exceeds $220 trillion. But let's use the little number, $100 trillion. Now let's add back the $29 trillion that's on balance sheet. Our federal government, that doesn't include state government, local government, private debt, or corporate debt, that number is $129 trillion. Andy, let's put that in perspective. The Internal Revenue Service, who has an interest in these things, suggests that their estimate of private wealth in the United States, wealth owned by you and me, is about $141 trillion. So if you take all the money that all of us have as individuals, before you liquidate the federal government, sell off the national parks, do that kind of stuff, that number is $141 trillion. And we've already spent $129 trillion of it. This is truly staggering.
Right.
And that number grows. Every year, the on-balance sheet obligations of the U.S. government are increasing by $2.5 trillion a year. And the off-balance sheet obligations are estimated to also be increasing by $2.5 trillion a year. So every year, we're getting $5 trillion deeper in debt. That $5 trillion is an interesting number because it's a little larger than the gross income of the federal government before they spend any money on anything, including debt service, which is to say our debt is growing faster than our gross revenues, not our income. I think that it is as politically unpalatable today to cut entitlements, cut Medicare, cut Medicaid, cut military pensions. Remember, some of those guys know how to shoot. Cut Medicare. I think it's as unpalatable today as it was in 1968. So what I think happens is that some old codger named Rick Rule continues to get his Social Security check. I don't know what it is, $4,000 a month, something like that. I think we continue to get the nominal value of our benefits. I think they fiddle around the edges, right? I think they probably increase the age that you have to be to receive it. I think that they probably remove the cap that rich people have on their Social Security payments. And I think they probably means test it, which means actually for old fat guys like me, I probably won't get it. But that's fiddling around the edges. What will happen for most people is that they'll get their benefit, but they'll inflate away the net present value of the benefit. They'll do precisely what they did in the decade of the 70s. They will reduce the purchasing power of the US dollar by, say, 75%. I might be wrong, in which case the normal investments that you have in your portfolio will do as well as they have the last 10 years. But the arithmetic that I've just showed you, which is to say the negative accretion of value that you enjoy today and the probability that that inflation increases in the future, is, I think, high enough that somebody who doesn't own gold as an insurance policy is crazy.